Compounding Interest in Investing. This is Ken Boyd. Comedian Mort Sahl was once described as, quote, a very likable guy who made ex-friends easily, which I think is a great line. The point here is that comparing yourself to other people can create a lot of anxiety. And these comparisons apply to every part of life: career, marriage, hobbies, fitness. And this process can become a vicious cycle. We compare ourselves to other people. We don't think we measure up, and then we stop trying altogether. The author and playwright Oscar Wilde has another great quote: be yourself, or everybody else is already taken. The point here is to move forward based on who you are and what you can reasonably accomplish. And the same view is true for savings and investing. Simply starting. Many people don't feel they can save enough for retirement, and they can't save enough generally. As a result, they don't save at all. Any amount is better than nothing. And if you were wondering where you could find dollars to save, consider your trip to Starbucks. Okay, so I didn't see the prices for items on the Starbucks website, but there's a great source called Hack the Menu that does provide prices. Let's assume that Grand Cafe Latte is $3.65 and the same regular size is $1.95. Let's say you run by Starbucks for that cafe latte 5 days a week. To save money, you decide to buy a coffee 4 days a week rather than the latte. So 4 days, you're going to change your behavior and buy something different. $1.70 times 4 is $6.80 a week. That's $27.20 a month, and it's $326 in a year, which actually turns out to be a fair amount of money. Which brings us to the magic of compounding. So you're not convinced that $326 is all that meaningful. Well, what if you invest the money at a 5% return for 10 years? Let's further assume that you reinvest your earnings each year, which is the key to compounding. By reinvesting earnings, you take advantage of the magic of compounding, and compounding means the ability to earn interest on interest, earning interest on interest. So let's say, for example, that you invest $100 at 5%. At the end of year one, you've earned $5. To use compounding, you reinvest the $5 that you earned at the same interest rate. So at the end of year two, you earn 5% on $105, not just $100. And your total earnings are $525, meaning that you earn an extra 25 cents by compounding. You can find lots of great tools on the web to calculate compounding interest. I like this. There's one from Bankrate. If you plug in 326, compounded at 5% for 10 years, the total is 531. That's an increase in earnings of 531 less 326 or $205, which is a nearly 63% growth rate over 10 years, which isn't bad. How long would it take your money to double? To find the answer, you can use what's called the rule of 72. Take your rate of return 5%, use that number to divide into 72. In other words, 72 divided by 5 is 14.4, meaning that it would take 14.4 years for your money to double. So the goal here is to start investing at whatever pace you can. Be yourself. Any amount of investing will pay off over the long haul, regardless of where you start, and you'll feel good about what you've accomplished. And for other great accounting and finance information, you can go to my Substack, accountingaccidentally.substack.com. Thanks.